Hello and welcome every one of you to this webinar. Welcome, ladies and gentlemen. It is my pleasure to be the moderator of this webinar. I am Nancy Naji, and on behalf of Deloitte, I'd like to extend a very warm welcome to all of you. We appreciate you for taking your time off your busy schedule to join us today. This webinar is focused on the Petroleum Industry Act of 2021, Nigeria's new petroleum regulatory framework. As we all know, the federal government over the years have sought to overhaul the petroleum industry. The first major attempt was in 2008 when the first PIB was introduced. Since 2008, there were other unsuccessful attempts at reforming the industry until 2020 when the federal government reintroduced the PIB to the current National Assembly. This parliament passed the PIB and the president signed to it on the 16th of August. In fact, today it's like a month. The president signed the PIB just a month ago. So this webinar is very apt at this time. Today's webinar by Deloitte will analyze and evaluate the impact of the provisions of the Act on key stakeholders as well as the Nigerian economy as a whole. There will be a keynote presentation in a bit, in just a few minutes, by Dr. Tim Okon. There will be two panel sessions. The first on the upstream sector, the second on the downstream sector. There will definitely be Q&A sessions, which if you have your questions, you can put in the chat box. We will take your questions. So without further ado, let me welcome you all again and introduce Yomi Olugbenro, who is the West Africa tax leader at Deloitte. Over to you, Yomi.
Well, thank you so much, Nancy. Good morning, everyone. Distinguished panelists and keynote speaker and all participants on this webinar. Very delighted to have you. My CEO is on the call, and he is indeed the chief host. So he will do us the honor of welcoming everyone. So I'm just the John the Baptist, introducing to you my chief executive, Fatai Folari. He used to be a tax expert himself, but I've since delicensed him. I've asked him to go and chase bigger money and run the big business. So Fatai, welcome to this webinar, and please, the official welcome from you as our host.
Thank you, Yomi, and I'm begging for my license, Yomi. Please restore it. Thank you very much, Nancy, and thank you very much for today. Distinguished ladies and gentlemen, good morning to everybody on the call and participating in this webinar. We really appreciate you. Dr. Tim Okon, thank you very much for honoring us as a lead speaker today. Distinguished panelists, we also welcome you to this session. Ladies and gentlemen, it's about the time that we have to have this. We also thank you for joining us again today, because we initially had this planned for 30th August before we had to postpone it due to circumstances being under our control. But be that as it may, for you to be a part of us today, we really appreciate you all, and we really thank you for being here. The Petroleum Industry Act has been long waited for. And from what we see it in Deloitte, is actually a major step by the federal government of Nigeria to actually enact this act after a lot, over 20 years of effort to bring it to life. So we at Deloitte actually appreciate the federal government for this bold step in taking this step and signing this bill to law last month. Ladies and gentlemen, this is a major step in terms of directing the Nigeria petroleum industry. We believe this could actually help to revamp the industry and actually help to redirect it. Some of us are aware that we've also yearning for regulations, the directions to which the petroleum industry should be in Nigeria. We believe with the enactment of this act, we are very sure that Nigeria will gradually start stepping into the right direction in terms of having a clear regulation, having a clear direction. If our industry will be able to have a big ability to plan, and investors in industry will also be able to have a direction that could actually lead them into a proper business model or try to plan for the future. Gentlemen and ladies, our intention today is actually to discuss with you and also to create a platform where we can actually deliberate on the major part of this act, come to a discussion point where everyone can start to chart the direction to which industries, players in the petroleum industry can start to think through what should we be doing. And it's also a way of enlightenment for people that are outside the country or investors that are not even within the Nigerian shore to start to think towards what should we be doing in Nigeria, to start to have a feeling that Nigeria is actually ready for future investment. Our ability today is to create that platform and to create that awareness in terms of where we can start to discuss and create a community of people that can take this forward. We're trying to do this with the intention of our belief that as a collective, as a Nigerian, we can continue to make a major impact in our economy, revamp the petroleum industry to the direction to which we expect, particularly when you look at the reserve that Nigeria has. This is a huge reserve. I mean, I'm talking to experts here, but I know if you look at it, it's estimated between 37 to 40 million barrels of crude oil right there in Nigerian environment. We believe this is a big opportunity for Nigeria to really direct these affairs. If we get it right and we're using the benefit of this Petroleum Act, I think a good day is ahead of us. We're also aware of the fact that there's a competition around sustainability. Climate changes are also affecting us, and everybody is thinking towards what are the alternatives to petroleum industry? What are the alternatives to products out of petroleum industry, industrial environment? The belief within ourselves is that the petroleum industry will still stay for a long time to come, and it's still worthwhile area to which a country like Nigeria should continue to invest and continue to think of ways to which we can annex the benefit. For us today, we're of the view that we can work with everyone within the room, create an environment where we can gather ourselves and continue to bring out the benefit of investing in Nigeria, creating an enabling environment that could propel a growth in the economy. With the panelists that we have today, with the team of people that are on this webinar, we're of the view that we have major interests. We want to develop the economy, we want to develop Nigeria, and we also want to work together. Before I round up, I also want to mention the fact that the act as we have it today is actually not the best. It's not really not taking care of everything. We've had comments from industry players and everybody talking about some other aspect to which this act should contain or should not contain. The point is, the Petroleum Industry Act as we have it today, it has done an attempt. It's started a journey. We believe any areas to which has not been covered can always be addressed in future legislation. For example, in Finance Act. Those are the opportunities to which we have at the moment, and we cannot but to continue to look at the benefit that is currently in the PIB as it's enacted and see how we can move it forward. While I'm not going to take the role of the panelists and Dr. Okon, I'm also willing to tell all of us that we thank you very much for being part of today, and we appreciate you all. Thank you very much.
Thank you very much, Fatai Falari, for that welcome address. Thank you. So at this point, I would bring in our keynote speaker, our able keynote speaker. I'm really itching to hear what Dr. Tim Okon would say, his presentation. Dr. Tim Okon is the managing partner at Techno Energy Resources Limited. Over to you, Dr. Okon. And I also want to urge our participants that after the keynote address, after the keynote presentation from Dr. Okon, we'll take the questions. So while you're listening to his presentation, you can drop your questions in the chat box. Thank you.
Thank you, Nancy. Yeah, I'm particularly honored to be here. And it seems I've been doing the rounds ever since this was passed, but I think that we are actually crossing a particular crossroad as far as legislation and reform of the petroleum industry. So I'm not going to spend too much time, but my focus is basically to introduce, for the short while that I have, important highlights. So the intentment behind the PIB has been articulated, and I think every panelist here knows what this is about. Most of our laws have been either the PPT of 59 or the Petroleum Act of 69. Those laws have needed a revamp. So it's an attempt to do that revamp. I'm going to go through the presentation by just having an introduction, talk about governance institutions, upstream regulation, and midstream and downstream. Then we would look at lease administration and of course talk about the fiscal framework. The National Oil Company is actually at the very heart of this particular reform. And I say at the heart because you need to understand that the National Oil Company, okay, holds the largest share, or on behalf of the Federation, that's what it holds on behalf of the largest share of reserves, so whether it is oil or gas. And how it plays is important to Nigeria's future. And you will note that when I come to that particular section, we will talk about the importance of these the changes in the law and the repositioning that is this law should bring. Okay, there is a background to industry challenges, and I don't want to harp too much on those, but there are about 5, and I think it's illustrated in the present and the slide that you have before us. I think perhaps the shock of the pandemic and acceleration in cheaper energy storage has brought some alternatives to bear on the industry as a whole. And of course, green hydrogen, there are many concepts out there. This is not where I will discuss them, but of course, Nigeria signed up to climate change targets, etc. So the industry is under pressure. And those are things that this law recognizes. Of course, because we announced back in 2000 we were reforming the industry, the challenge was that once you have given an indication, then everybody sits and waits. So uncertainties build up. And I think that is that became an issue, and investments basically go to where people have, because the span of oil investments is not instantaneous. You're looking at a long range. So that uncertainty now would be addressed by simply having a law in place with all the whats and all. That is, you might, maybe sections you might want to be critical of, but I think this is a particularly robust document. To the next slide. Okay, of course, peculiar challenges. We know about high tax rates, you know about high cost environment, you know about which of course the fiscal terms itself and fiscal abuse, etc. So those were the things that guided the team that has over the last 15 years been looking at fiscal reforms. Next slide. Okay, and our peculiar challenges is anchored with the fact that the entire midstream is less developed, and that's why when you refer to Nigeria as a rentier economy, we simply export hydrocarbons, primary goods, and a bit like the cocoa and groundnuts we used to, and then we import processed goods. That has remained a hallmark, and I'm glad to say that there are specific provisions in the PIA that actually addresses this. It might not be of interest if you are in extraction. That is, you simply extract and you take it out, which is the model for most of the IOCs here. But it is an important impetus for the holder of the largest set of reserves, which is the National Oil Company. And the way in which we have shaped the National Oil Company is that it must respond to this particular challenge. So the midstream has a peculiar focus for this reform. Next slide. Okay, so we have a governance structure, policy and regulations. Of course, policy lies in the office of the minister, and as you would note in the document, regulation essentially with the two regulators, the upstream commission and the midstream and downstream authority. The regulatory space is actually separated by also a fiscal boundary, and I would illustrate that in coming slides. Next slide. Yeah, again, with policy and regulation, you have, of course, boards with the two regulators, and there will be a governance, and these are independent regulators. The powers of the minister is limited to shaping policy, okay, except for where the minister has to grant or revoke licenses and leases, etc. But everything is done with the regulator, and this revocation or granting is upon the recommendation of, say, the commission or the recommendation of the authority. That is an important difference to note. We expect that some of these changes would enable greater professionalism, and secondly, would fast track the process by which approvals are obtained. And I think that would be music in the ears of commercial operators in the industry. Next. Okay, so you have, like I said, the third arm of all this, the institution, is NNPC Limited. Of course, independent regulation involves administering an industry that, if you do go to principles of economic regulation, the intendment of regulators should not be to basically drive down the activity or stop the activity from them. So the mandate of the regulatory space, regulators would essentially be to encourage, and there will be in regulation, what we call regulatory pyramids, in which laws of what you have self-regulation, and then it goes sequentially to more and more regulation if there is no correction of the whatever led to the regulatory intervention. So that is the basis. And when you look at this document, you need to look at what will accompany it, because there are lots of regulations to be written, which will have that process I mentioned in mind. But I'll focus my attention on NNPC Limited, because this is part of a key reform. First and foremost, if you go to Section 53 of the Act, it says within 6 months you would have NNPC Limited, which would be a limited liability company. It will be owned by MOFI and MOPI in equal proportion on behalf of the Federation. So it's going to be a limited liability company with shares. It also says that there will be capitalization of the shares to be that the share capital will be determined by both by the Minister of Finance, and within 18 months, assets, Federation assets or any other asset will be transferred to NNPC Limited. And then, of course, it goes through the process by which that will happen. And thirdly, 6 months thereafter, okay, whatever companies or entities from NNPC Corporation that has not been extinguished will revert to NNPC Limited. 2 points here. First, a commercial organization. In other words, from the get-go, NNPC Limited would be solvent, not insolvent. In other words, the assets and liabilities, the assets would exceed its liabilities. Those are some of the what you can infer from the intentment of Section 53 and Sections 54 of the Act. Next. Okay, but in all of that, it also includes what I call fiscal rules or fiscal handcuffs. So the NNPC is supposed to be commercial. In other words, you cannot be running a business where you have costs but no revenue. So those revenues have to come in. 2, it needs to be profitable. 3, efficient, cost efficient, etc., because there will be no recourse to funding from the government. So self-funding, in other words, that tree has to produce its own money, and there are specific requirements that any mammoth, any subsidiary of NNPC Limited or NNPC Limited itself has to conform with a special requirement that exists in the law, that the mammoth, the memorandum and articles of association, should contain certain features, and it should expressly state what the intentions of the law is, you know. And finally, it says NNPC can retain 20% of its earnings. So you can call this like something like handcuffs, but there are specific rules. In other words, NNPC, and this is in Section 64, NNPC has to be commercially run, but additionally, it will have to be competitive. In other words, it will be run comparatively to other companies that operate in Nigeria. That is a particularly very important. In other words, the drafters and obviously the government expects that NNPC's balance sheet and financials, etc., will be compared from time to time. And that is actually the mandate that the new company would expressly be given, and that's why those are in the law. The 20% retention, obviously, it's an indication that the more profit you make, the higher the higher amount that 20%. And because NNPC needs to be self-funding, it will be structured in such a way that it has a benefit of its capital allowances and other allowances, etc., that comes with it. Okay, so next slide. Well, what are the features of national oil companies? I have here some key attributes which are important. First, you need to have self-funding, which is exactly what you have in the law. Financial authority, but of course with accountability. So you have what I call fiscal rules or fiscal handcuffs. Okay, a strong performance bias that if you a profitable operation, in other words, operational resilience and financial resilience. It is key, and of course talent as people, making sure that you avail yourself of the best. The talent pool is there for NNPC to exploit. So next slide. Okay, I'll speak a bit about lease administration before we go into fiscals. There are strong drill or drop provisions. There are conversion of OMLs. This is a recognition of the very fact that people may wish to exercise some options and to settle some disputes, especially with the PSC. So there's an option to stay within certain schemes, and then as long as you have your mining lease, once it expires, of course, you have to convert to the new terms. So it grandfathers certain existing leases and contracts, etc., so as to ensure that those who made investments on the basis of fiscal agreement can continue with those investments, and those who elect to be under new and more favorable terms could elect to do so as well. So it creates this flexibility and seeks to resolve some of the disputed issues in arbitration, etc. So next slide. Okay, still on lease administration, I spoke about the deep offshore in particular. Okay, and there were negotiations to this effect, and I think those should now be concluded within 18 months. This would have to be concluded. So there are negotiations ahead, and those who elect to either be in under existing terms or proceed under other terms, etc., would proceed to do so. Next slide. Okay, let's look at the fiscal framework. Well, there are some key differences here. The new fiscal proposition is first and foremost that there will be a dual tax system, and we can debate the benefits of dual tax. I think my general overseer, I call him Gio, is here, so he will. This was exhaustively debated, but that structure is that in the upstream, all companies in Nigeria need to pay companies income tax. Now, the high tax rates of 85% and so on that we had in the past also meant that if you are a company in the upstream, if you say, for example, interest expense, you recover it as the higher tax rate and so on and so forth. So what we've done now is a levelized fiscal system that recognizes the company as a payer of income tax, and then because it's a resource company, you pay a resource-based tax called the hydrocarbon tax. And there are various triggers in the fiscal system, which we wouldn't have time to discuss, but I've said dual taxation, and then it also incorporates royalty by price. Royalty by price is that if you have cases where high oil prices, then the trigger, which is set at $50, will enable the state to get a share of this. The intentment here is quite simple. Nigeria has a sovereign wealth fund, which is not as fully utilized as it ought to be. And I think part of our fiscal stabilization, etc., looking ahead for this depleting natural resource was to introduce some mechanism by which that sovereign fund would have income saved for the purposes of the future generation, etc. So this has that feature in it, the royalty by price, and at the trigger of $50, less than $50, there would be no. It just removes the debate that is often had as what should that trigger point be. And let me just state this: in the last 39 years, if you look at analysis of oil prices on a nominal basis, the average oil price comes to about $37 a barrel. 67% of the time, oil prices have stayed below that $37 a barrel. 33% of the time, it has stayed above $45 a barrel. So the trigger point of $50, essentially, if you look at the analysis that was done, was that if you place it there, then you could truly state that you have a higher oil price, and that's why that trigger is there. And then the royalty rates correspondingly would kick in, and the maximum would be 10% at $150 a barrel. Next slide, please. It removes cost-based incentives and introduces production-based incentives like production allowances, etc. One of the areas where we have difficulties with cost control is an area in which investment tax credits and investment tax allowances. Those are a function of how much money you put in rather than how much production you have made. So that sort of, we're realigning incentives to production, because the state benefits when there is production. It doesn't benefit simply because you have incurred costs. Secondly, there is something called cost capping. It's a cost price ratio, and basically it's a mechanism that that derives itself from the MOU that we had, but it's typically a way in which you more or less know what the state can determine how much government take it can have in any 1 year. So that cap is at 65% of the revenues, so that you know what is similar to the minimum tax provisions under the PPT, and also the 67 or 66.2% limits that under CETA of assessable profits under CETA. Next slide. Okay, the proposed new terms, if you look at the hydrocarbon tax, depending on what type of acreage you have, if you have converted acreages, then onshore is 30%, shallow it's 30%. Then if you have new acreage, it's hydrocarbon tax is 15%. Of course, some of the criticism is that, there is some complexity around the different tax schemes, etc., or the tax rates. Well, I think this is just an Excel sheet problem, and most people who model economics, do economic modeling, can handle this. Then you have a graduated or royalty scheme, which also reflects production and, like I said, royalty by price, and that's the royalty by price there. Above $150, it's 10%. Below $50, it's 0%, and then you have a ramp there that I think it's 1 percentage point for every $1 increase in oil price. Then, of course, royalty for gas, you have 5% flat rate royalty, and for dumb gas, 2.5. Gas that is intended for the domestic market is 2.5%. Again, is an incentive for the midstream, which we will talk about later. Next slide. Okay, could you just go back one? Yes, of course, royalty for oil and in the onshore and shallow water for small fields. So this captures the marginal fields, but what we have done is essentially to state that that whether it's a small field from the get-go or fields that are approaching their economic limit. So once production begins to decline, it's approaching economic limit, those who have such fields would get a lift. Where royalty now becomes lower, scaled down depending on the production rate. And that is what this is intended for. Next slide. All right, host community. I think this is just one of the things that ended up being wrapped in controversy, etc. But I will say 3 things about this. First and foremost, the intention of this particular section is to ensure that there are but in actual revenue, terminal revenue. To ensure that there are projects that are done in the host communities, and therefore direct participation of the host communities in their own development. The responsibility is that of the settlor to set up a host community trust fund. And who is a settlor? And the host community is defined as any community that is within or pertinent to, which is basically related to or close to the upstream facility, etc. Those would be host communities. Then it defines a settlor as a license or a lease holder, okay, who is operating, which basically the settlor sets up this authority. So that removes midstream facilities, etc., which would have just caused the purview of the host community fund to extend almost limitless, more or less. And it avoids the term impacted communities, which is, it's difficult to say what impacted community would mean, and that removes some of the ambiguity. But furthermore, all of this will be set up and approved by the commission. Next slide. Now, there are restrictions as to how the host community funds will be spent. And specifically, 75% will be for capital projects, 5% will be administration, and 20% will be in a reserve fund. And I think that the law seeks here to make it very clear that these are not monies to be spent in a manner inconsistent with the law. Of course, there will be regulations to underpin this, and they're subject to the monitoring of the commission. Of course, this is in addition to any other sources of funds that come into the main areas, which are really the Niger Delta in particular, but other states and other areas could easily join this, because the host community definition is clear. It's not related to what part of Nigeria is related to where there's petroleum prospecting license and an oil mining lease or petroleum mining lease. It is set at 3%, and people argue why 3%. It was actually set at 2.5%. I think the National Assembly moved it up to 3%. It's essentially recognizing the amount of resources that have been spent here, and the operating expenses of the entire industry comes in at about $15 to $16 billion, and 3% of that would be $480 million, which would be money available for host communities wherever they may be. It's a significant sum of money, because in some instances, this money per community could exceed the allocation to the local government itself from the general pool. So potentially you have that. And with these rules, some of the abuses that have been mentioned in press regards to some of these entities will not occur. And this is why you have those fiscal rules that will be applied. Next slide. Okay.
Doctor, please, you have just about 2 minutes to end your presentation so that your questions can come.
Nancy, I'm about getting there. So I have 4 slides left. What are the benefits of the PIA? I spoke about the midstream because when this was done, clearly in our minds, we were focused on ensuring that this leads to industrialization. The national oil company plays a key role in this. And if you look at section 64, it says it needs to embark on that industrialization step. There is in Nigeria something referred to as the Nigeria Industrial Evolution Plan. And in my discussions within the national company, etc., this is clearly understood. Secondly, you look at the benefits of oil-based industrialization. Nigeria hardly does anything with its refineries except to basically use fuels. The non-fuel aspect of refining, etc., is hardly. Now there are incentives to do that. And what are the incentives? Under section 39 of CETA, we have included any midstream oil and gas operations will qualify under those terms. So it's a clear indication that we are trying to here incentivize the midstream. Then, of course, gas-based industrialization, all the things you could do with gas. In particular, I want to mention section 317, where we deal there with the domestic supply of gas. And clearly, to avoid all the historic mistakes and obfuscation, it clearly lays a framework for which domestic gas will be delivered to Nigeria. It is a three-tier system and is defined by law. So clearly, the cheapest gas in Nigeria must go to the domestic sector. Okay, and there are incentives also, the 2.5% royalty rate for non-associated gas. You do not have, there is no hydrocarbon tax, even with respect to the liquids that are derived from the gas. So the incentives are there, and I think that the roadmap for reindustrializing Nigeria, so to speak, is here, and we hope that it will be integrated into the National Industrial Revolution Plan, that both from the point of view of the small fields, the flare out, etc., all of these are now being strategized and put into a context that will enable the development of anywhere where oil and gas is produced in the country. I want to add a comment about host communities. All the flares, the midstream infrastructure funds, which are midstream infrastructure is with the midstream authority. That fund is also available for flare outs on midstream projects, and that is in essence what the PIB is incentivizing. Thank you for listening.
Thank you very much, Doctor. Thank you very much, Doctor, for that incisive presentation. In fact, during your presentation, I've been seeing a lot of comments on sharing your slides. So I would crave your indulgence that your slides should be shared to participants on this session. Thank you very much, Doctor.
Yeah, thank you.
Okay, so the Deloitte team will work with you on that. But Dr. Justin, in 1 minute, because there are a few questions coming in, but just in 1 minute, because we are pressed for time as it is. Let's take a question for you from Oyekachi Kali. And Oyekachi is asking, what is the implication of setting up the steering committee that has 12 months to complete its assignments? Is the implementation of the PIA in abeyance until after the 12 months, or is it the legal framework under the PIA of immediate application in the oil and gas industry? Did you get that, Doctor?
Yes, I did. Yes. Let me say that the steering committee is in place, and the role of steering committee to do two things: is to give governance over the implementation process. Below the steering committee is a working group, and I can say that that group is being composed as I speak, and meetings are being held, And once the steering committee meets, it will make some approvals as to how this would be embarked upon. But the structure is set, and I'm not authorized to disclose the details of what that structure is, but areas where all of this will be tackled. If you recall, in the law is section 53, and there are sections like that where there are specific time bounds that things have to be done within a particular time. All right, and those, the steering committee and the working group, it's there to ensure that there's strict adherence to that to the law. That's where that comes in. So, in effect, it's a tall order, but work needs to be done, and I'm sure it will be done. I think the people who are involved in it were also, there are some people who were involved in the drafting of the legislation, and therefore they actually know what and what needs to be done. There will be regulations written, but I would say that the regulations, all existing regulations, as long as they are not inconsistent with this act, remain in force. So I think that's also clear. But those that are not consistent with this act, of course, but that process of writing regulation is commenced, and then how the entire process will be run. The third tier is the tier at the levels of the NMPC Limited, at the levels of the commission, and at the levels of the authority. And those would, the people, they will be manned, and there will be transition committees that will be looking at things. So that is a 3-tier system, and it's being worked on as I speak, yes.
Thank you very much, Doctor. Thank you for answering that question. So many comments coming in through the chat box, and I can see that we have, a very incisive commentary going on the chat box amongst our participants. So that is encouraged. Like I said earlier, the slides will be shared. Doctor slides will be shared to everyone. I can see that our participants are dropping their emails, so the Deloitte team will work with Dr. Kohn to, send his slides and his presentation to all of us. And Deloitte would also, this session is recorded. This recorded video will be uploaded on Deloitte's YouTube channel, so we can also have the privilege of watching this over and over again, even after this webinar. I want to welcome participants that are just joining us, because I see that we're having more people join us. So thank you all for joining us. I hope you haven't missed much. If you've missed from the beginning, you can find the video on YouTube. Now let's go to our first panel session that will be focusing on the upstream sector. And I'm going in quickly by introducing our panelists for this first panel session. Mr. Olusegun Olujobi is the Chief Executive Officer at Vertex Energy Limited. Mr. Gabriel Ogunjem Lucy is the Director Oil and Gas at the Federal Inland Revenue Service, FIRS. Mr. Lumide Eson is a partner, Tax and Regulatory Services at Deloitte, the host of this webinar. Mr. Uyu Zeko, a partner, Business Process Solutions, also at Deloitte. 4 panelists to do justice to this first panel session that would focus on the upstream sector. So I want to welcome all my panelists. Welcome on board. Let's shoot very quickly. The first question will be for Olusegun Olujobi. And Mr. Olujobi, I want you to take this, comparing this PIA, that's the Petroleum Industry Act, to other pre-existing petroleum laws. Are there fiscal provisions and available incentives sufficient to encourage FDI into Nigeria? So, Mr. Olujobi, you can take it from there. Please answer the first question.
Thank you very much, Nancy, and congratulations to everyone. And Dr. Okon, thanks very much for a very excellent presentation. I think the answer is yes, there is a lot in the bill around clarity, around improved fiscals. There's really a lot in the bill. Of course, no bill is perfect, like Dr. Okon himself said, and there are issues that we have as operators and players in the industry. But let me set context. One of the challenges with this bill is that it's come a bit late. I mean, if this bill had come 10 years ago, 15 years ago, we're very euphoric. And the reason why I say so is that as Dr. Okon himself mentioned, the environment has changed a lot. And in some parts of the world, talking about oil and gas is really a challenge, And I'll give you a simple example. And the problem in Nigeria is that we don't even have enough capital for the industry. So if you look at this industry at the stock exchange in London, where we raise a lot of money and our most successful E&P players raise money, between 2005 and 2015, $3.3 billion was raised every year on average as equity raised to the E&P sector. In 2019, only $625 million was raised. That's a fifth. In last year, only $449 million was raised. So one of the big challenges with this bill, in spite of the fact that the provisions are many interesting provisions and very attractive, is that the industry is really starved for funding. So it's a good bill. It's come a bit late. But having said that, we as industry players, we like what's been said around a reformed NNPC. We like what has been said around regulators and having more efficiency around that. The challenge for us, and as most Nigerians know, is implementation. So one of our big concerns is around implementation. To the extent that the reforms happen quickly, we'll be excited. And so this law is a good law, not perfect, and there's some challenges, and I don't want to go into those challenges right now. But I think, be that it may, we as an industry, I think we're happy. Having said that, there are a number of provisions that we hope will need to be relooked, and there are a number of things that in context need to be right before we can really say this is Uhuru. But to answer your question directly, this law and the fiscal provisions do make a lot of sense, and they point us in the right direction. 2 points before I stop at this point is that this law, as Dr. Okon himself has mentioned, if you're an efficient operator, you can make money. The challenge with operations in the Niger Delta is many of the things that are, cost are not within our control. One of them is, security around pipelines, for example. Another one is that if you're in a JV with the national oil company, for example, sometimes the bureaucracy of the national oil company affects your costs. The regulatory environment. So the question will be, will people jump at this bill and want to convert immediately? I think it will be on a case by case. But people will have to look at their case and say, look, if I convert now, given my experience with my costs, given the cost issues on the Niger Delta, given the inefficiency, would I be in a good place or a bad place? So I think many people will watch and see and look at the economics and the particular context to decide what they do. But overall, there are many significant improvements in this bill. And if you're an efficient operator, this is a good bill. So that's what I'd just like to say at this point in time. Thank you.
Thank you very much, Mr. Lujobi. Let me move over to Mr. Ogujemi Lucy from the tax compliance and administrative side. Mr. Ogujemi Lucy, let's take a look at the tax compliance obligations that may arise as a result of perhaps the requirements of the PIA for unbundling of integrated oil and gas companies into separate companies along the sector lines in the industry, that's the upstream, midstream, and the downstream. We'd also look at perhaps voluntary conversion of currently unincorporated joint ventures into incorporated companies. I also want to say, just before Mr. Ogujemi answers, you can send your questions to the chat box for any of our panelists as you listen to their answers. Thank you.
Thank you, Nancy, and the distinguished panelists. Dr. Okon, thank you for the well-presented paper. In fact, I've dealt with everything, including the fiscal. Concerning the issue of compliance in the PIA, as regarding the unbundling of downstream, midstream, and upstream, I don't think there's not going to be too much different from what we are having presently, because in the present law, companies are complying in terms of filing their returns. And now we are talking, we said that the company should unbundle to different companies to manage the midstream, downstream, and the upstream. So it's going to be different company filing different returns. It's not going to be with the same company filing different returns. But in terms of, and with the way the something is even structured now, it's even going to be more easier to comply at the corporate level. Because at the corporate level, you can consolidate all the costs. It's only on the upstream level that petroleum upstream operation that you can consolidate if you are in different, if you are in the new regime or you are a new entrant or you convert. That's where you need to file different returns. So the compliance is going to be more, I would say, more favorable than what it's a little bit than what we are having presently. Then as regards the issue of, okay, on the estimates too, estimate returns, we are having them presently. Company file their estimates on monthly basis. And when the operation of new business too is going to be in that order. So the compliance is not going to be too burdensome on the taxpayers, in my view. Which other question? I think that's another one you asked.
Yes, the other one is, yes, the other one is about voluntary conversion of currently unincorporated joint ventures into incorporated companies. Okay.
I think that one too has its own benefit. There's not going to be additional tax burden to be imposed on it. The company will just be filing their returns because the moment it becomes a incorporated joint venture company, it's a company on its own, it has to have an entity. So it will file its returns as a company on its own. But the conversion, every cost will be incurred in terms of conversions and in terms of any additional tax. There cannot be any additional tax as part of transfer of assets and all those sorts is going to be is waived. And even the issue of stamp duty and everything there, even so also that also is available to unbundling into different streams. No additional tax burden to be incurred in terms of conversion, either to incorporate joint venture or unbundling from upstream to midstream. It's part of the incentive that the PI has put in place. Thank you.
Thank you very much, sir. Let's move over
Nancy, if I may just add, sorry, if I may just add a comment there. I think the national oil company has to comply. So the rules that apply to any private company as per the PIA would also apply to the national oil company. So I just want to add that critical comment that if everybody has to unbundle, NNPC has to unbundle as well. Thank you.
Okay, thank you very much, Dr. Okon, for that intervention. Let me move over to Olumide Eson. Let's take a look at transitioning from old laws to a PIA. Dr. Okon gave us an incisive presentation too, but Olumide, what steps should companies operating under the current licensing regime take in deciding on whether, to remain with the existing licensing regime or to convert to a new licensing regime under the current law which we have?
Thank you, Nancy. And again, I always would say congratulations to Nigeria. We've been on this journey for over 20 years. And thank you, Dr. Okon, for the presentation, and also good morning to distinguished panelists and our participants. So ultimately, the companies would have to make the decisions based on economics. The companies would have to review their individual, project economics and also portfolio level economics to decide whether this is beneficial to convert or not. Bearing in mind that what are being converted are the licenses and leases, you would have to, be in alignment with your joint venture partner. So when you've determined that this is it's a good one to convert to PIA, then you need to seek alignment because you are holding an undivided license with other JV partners, and I think it's more important to actually first get it right from your own economics. Having done that, having done your model, it's advisable to get an independent external advisors who are knowledgeable, and experienced in this to review for you. Probably, firms like Deloitte and the rest can help you actually review the model to be sure, because you're making very critical decision here, whether to cut over from the current, PPTA and the Petroleum Act regime to the PIA. I think one additional thing to note, particularly for companies involved in the production sharing contracts, is the possibility of having to lose part of the acreage as part of the conversion process. I imagine that this will already be factored in when you're looking at your portfolio level economics to be sure that you're making the best decisions. And this is more important, particularly for companies that the licenses still have quite a number of years to go. Typical license probably have 20 years. So if you have an existing license that has got 15 years to go, it's really critical to do this economics, to make the consultation, to make the reviews, and be sure that the PIA serves you better than the existing regime. Perhaps for leases and licenses with less than 5 years to go, maybe less of a concern, because anyways, after the expiration of your leases or licenses, you automatically be converted to the PIA. So bottom line is what works best for your companies. It's going to be driven by your economics, and just make sure that you do that very thoroughly and get it reviewed for you by an independent party to be sure the numbers are right. Thank you, Nancy.
Thank you very much, Olumide, for that. Let's move over to Uyi Zekon. Let's talk about the best way to manage the fund. Mr. Ezeko, this question is for you. The best way to manage the fund to make sure that the objectives are met and all stakeholders are happy with it.
All right, thank you very much, Nancy. I want to say a big thank you to Dr. Timothy Okon. I think that was a very insightful presentation. Dr. Timothy has already mentioned quite a lot of things around the Host Community Development Trust. But to your question, the first thing really is whether there is an extra layer of burden for operating companies with regards to the setting up of the trust. So clearly, setting up of the trust, like they say, the devil is in the detail. There's quite a lot of activities, a lot of processes, a lot of things that need to be done to guarantee that the objectives of the trust are actually met. And the way the PIA is written, especially with regards to the Host Community Development Trust, is that the ultimate responsibility of the trust really lies with the operating company, even as far as the assets and liabilities, and that really comes to bear when the Act was talking about transfer of licenses and what then happens to the Host Community Development Trust. Now, with regards to how best the trust can be run to ensure that the objectives of the trust are met, there are quite a lot of things that have been specified by the Act. Setting up of the Board of Trustees. The Board of Trustees then set up the Management Committee. The Management Committee set up the Advisory Committee, and all of this. But in terms of operationalizing the trust, the key things are, one, ensuring that there is a proper setup of infrastructure, the IT infrastructure, the accounting systems, the planning solutions, the appropriate dashboards, that will ensure that they will enable stakeholders to have visibility of what is happening. And beyond that, there has to also be the setup of the accounting processes themselves, the procurement processes, the reporting processes, the fund management processes, generally the bookkeeping processes. Like I said, the ultimate responsibility with regards to functioning of the fund actually lies with the operating companies. As a way of ensuring that operating companies focus on their core business, one of the things that they can do is actually outsource some of these very mundane, operational activities, and ensure that even from the advisory committee, the management committee and the board of trustees are focusing on monitoring the projects that are doing the technical part of requirements of the trust, and then outsourcing some of these or other areas around the operationalizing the day-to-day bookkeeping and running of the fund. It's also important to mention that there is the requirement to prepare a set of accounts, both at the management committee level on a 6-month basis. There's also the requirement to prepare audited set of accounts on an annual basis, which is going to be filed to the commission. And that is another extra layer where operating companies need to plan ahead and ensure that all of the structures that I mentioned in terms of having the right people, whether they're third-party organizations that will then run all of these operational areas to ensure that at the end of the day, you don't then begin to have another level of fines with regards to filing of the financial statement. Thank you, Nancy.
Thank you very much. Let's move back to Mr. Olujobi. For those joining us now, Mr. Olusegun Olujobi is the Chief Executive Officer at Vertex Energy Limited. The question for you, Mr. Olujobi, is I want to have your thoughts, on the impact of the Petroleum Industry Act on upstream businesses such as yours. How will this PIA affect businesses like yours?
Thank you very much, Nancy. Like I said, look, I mean, this bill, first of all, gives clarity that investors are looking for. And there are a number of positives, and I think Doctor has covered a lot of them. Significantly improved fiscals, but with the caveat that you must be efficient. You cannot get the benefits of this fiscal unless you're efficient. And like I said earlier, this then means that you've got to work with your partners, and we've got to work, and we hope that the NNPC Limited and the regulators are able to settle down quickly because they're very important in this efficiency. I think you had spoken about the opportunity to create incorporated JVs. I think the law appears to be, encourage that, which we think is important, given the paucity of funding. I had spoken about the fact that equity funding to the industries is limited. The same thing with debt funding. If you look at the amount of debt available because of the great move against fossil fuels, that's also limited. So efficiency is important. And I think the IJVs will be interesting. I think the only challenge, again, one of the areas we would like maybe some thoughts to be put into around the IJVs concept, incorporated joint ventures, that the law is a bit prescriptive, but obviously a lot will depend on the new management of NNPC Limited or the management of NNPC Limited at the time when they settle to look at those prescriptions. There are obviously a number of concerns. I think we've covered them earlier, and the fiscals are more complex. Dr. Okon is right that if you have a good set of spreadsheets, you can model this. But I think our concern as industry is just the regulatory side. We don't know, and if you look at the penalties are very steep around compliance. And the taxman has a lot more power because he can refuse to accept your assessment. So that's a concern for us. Like Dr. Okon said, the fiscals have been written in such a way that government continues to make money, which is not bad, but it means that there'll be times when, even though you are making a loss, you still have to pay hydrocarbon tax just because of the way the CPR is set up. There are concerns around gas. I mean, gas, even though you're asking me, I mean, we're mostly upstream, but, because of the value chain concept of gas, even though there are a lot of improvements in the gas area, but we're concerned about the lack of liberalization of the gas prices. There are unclear definitions around things like royalty, measurement points and so on. Basically, bottom line is that this bill is going to impact us a lot. There are a lot of positives. And you will really get the benefit when all parties, the national company, the regulators, everybody is working in tandem. So this will impact us positively. Having said that, we need to bear in mind that the big challenge the industry is facing, in addition to this regulation, is the fact that the anti-fossil fuel movement is really a big challenge to all of us. And the regulators and the fiscal authorities have to also bear this in mind as they implement the policy for the sector. So overall, positive changes, but a couple of areas, a couple of tweaks that we think are going to be important, and continuing to monitor the global environment and the paucity of funding to the industry will also be important to make sure that Nigeria does get the benefit from this improved law that we've seen. Thank you.
Thank you. Thank you very much, Mr. Lujobi. Let's bring in the taxman, just like you said, and the taxman here on this panel is Mr. Ogujemi Lucy. So let's talk about in what manner really does the tax authority intend to encourage the filing of estimated as well as actual tax returns during the 18-month voluntary conversion period?
Thank you, Nancy. If you look at the law critically very well, you know that the first return will be filed under PIA for the converted blocks will be February 2023. That's 18 months from the commencement date of the Act. And look at the estimated return for year 2023. And between now and then, definitely, even now in the old law, they are filing the estimated returns. So we don't need to, except for the indigenous oil company that need to be brought more on board now. Those are the areas that we just need to work on more. And we are coming up with templates that are going to make it easier. The issue of filing of returns to the template will become, we'll come up with template. And don't forget that we have a Tax Pro Max now, which we want to develop up to take dollar transactions. Taxpayers will be filing their returns online. And that means that the issue of compliance in terms of filing will be drastically reduced. And we hope between now and then, because Tax Pro Max is now running very well for Naira transactions, and for dollar transactions, we are about coming up with that maybe before the year or so, we should be done with that. So it will encourage compliance more than what it is now, that the taxpayers need to come to us physically to file the returns. Thank you.
Okay, thank you very much. Olumide, let's know from your own perspective if you think that the fiscal terms under this PIA are more favorable compared to those in the pre-existing laws. Are the fiscal terms under this new law more favorable?
Thanks, Nancy. On the face of it, it does appear more favorable. And of course, we all heard the keynote speaker earlier on. However, at the end of the day, each company would have to look at its book, look at its economics, to be able to decide whether or not this is a more favorable term than what we currently have. But then when you look at the taxation, for example, the headline rate has dropped from 85% for oil to a maximum of 60%. I mean, the 60% are broken down into hydrocarbon tax of 30% and corporate income tax of 30%. And also, if you look at gas had remained at 30% because it's also currently under 30%. However, for non-associated gas, the condensates and liquids from non-associated gas, which could have been taxed at 85% under the existing regime, will now solely be taxed at 30%. So, that also looks great for the gas business. For deep water, currently 50%, the rate also has been dropped to 30% because it will only now be taxable under CETA. And that's why I said, if you look at it on the face of it, the headline rates, these are much better than what we currently have. And also, if we move on to royalties, the royalties based on production, the maximum under the current 1969 Act is 20%. That has dropped to 15%. That's the maximum. And it could be as low as 7.5% if you are, into deep water or frontier. So, and 12.5% for shallow water. So on the whole, it will seem as though it's better, but also again, going back to the issue of economics, we also mustn't forget rather, certain things have also changed in the rules. Dr. Okon mentioned the cost price ratio. Essentially, what that does is to penalize, cost inefficient companies. But what that does actually is to limit how much of deduction you can have in any particular year to 65%, of your revenue. So, that itself may have cash flow implications for the companies. And of course, because that means you have costs you have incurred, but you cannot take tax relief on those costs. And also for royalty, government has also introduced price-based royalty, which Dr. Okon also mentioned. So the combination of this price-based royalty and also the inclusion of cost price ratio are kind of factors to consider in really, when you do your economics, to know whether you're in a better position under the PIA than under the Petroleum Profit Tax Act. But again, going back to what the headline looks like, of course, significant drop from 85 to 60, and then for royalty from 20 to 15 for oil, and for gas, lest we forget, from 7%, which is maximum royalty rate now, it drops to 5% under the PIA. And if your gas is even for domestic utilization, it drops as low as 2.5%. So, just looking at it on the whole, you can argue that this is better fiscal premise to work on than the Petroleum Profit Tax Act and the Petroleum Act of 1969. Thank you.
Okay, thank you very much, Olumide. I think at this point we'll get into the Q&A session, and from the chat box I can see quite a lot of questions, but I will start with this question from Boyega Olorunfemi. He's asking, what is the cost of this transition? And this question is to our panelists, so the four of you, but I guess this question should be to Olumide Esona. What is the cost of this transition as triggered by the signing of the bill into law? Do we have a measuring mechanism to monitor and evaluate progress? What happened if the milestones of 6 months and 24 months transition are missed? Thank you, Boyega Olorunfemi. Olumide, I hope you've taken that down. Let me just read another question so that we can take them at once. This is coming from Oge Chaineke. I have a very salient question. There seems to be a complete overhaul of the institutions that administer the Nigerian oil sector. DPR, PPPRA changes that border around staff movement across different industry parastatals. Curiously, there is an obvious exclusion of the Ministry of Petroleum Resources itself. If the Ministry of Petroleum Resources is still to play its supervisory role, why does it seem structural changes have not been included for the minister? Can the experts shed light on this? Thank you very much. Olubanji says, shouldn't Nigeria be preparing for a post-petroleum world? Valid question. That's from Olubanji Ujewale. Okay. We have like 6 minutes to almost 10:30. Let's take this last one. Okay, it's from Boyega Olufemi. I think he has asked the question earlier. Let's make it wider. Okay, Inform Idorenyi Udom is saying, okay, many thanks, Deloitte, for this opportunity. Will the host community fund nullify the existing MOU with the host community? That question should be for Mr. Ezeko. I hope Mr. Ezeko got that question. Let me say it again. Will the host community fund nullify the existing MOU with the host community? Okay, Mr. So you can start with your answers there. I hope you got the question I read earlier.
Yes, I got the questions. So let me start with the easier ones. What does this mean for the Ministry of Petroleum Resources? I think it's important to note that currently the regulators, whether it's PPRA, whether it's DPR, MDAs, they are part of agencies under the Ministry of Petroleum Resources. Okay, so even NNPC. So when we talk about this restructuring and matching skills to capabilities and to requirements, it will be done holistically by the implementation committee and other subcommittees, which Dr. Okon has mentioned earlier. So The government is taking a holistic look at this, and they want to ensure that the most capable person is posted to handle, the responsibilities which, have come out of this, the upstream commission and the midstream and downstream regulatory authority. So it's a holistic thing. He said earlier, and I'm going to reiterate that one of the things we are seeing now is, unlike before, where the powers of the DPR is derived from the minister, now we're having a National Assembly, legislates on the roles of the regulators. And by the way, the chief executives of these regulatory authorities and commission will be subject to National Assembly confirmation. So, that kind of, it's a big governance change, which kind of give them some more level of independence. So the staffing and all that to be worked out, and, it's, no one, I mean, there are no planned, redundancies, because I think these are all provided for, and even the terms of service are provided for, not to leave anyone short of what he or she was before the PIA. So I think that's really very easy to answer. I think the second one is the easier. The second one talked about the post-petroleum world. I think all the speakers, one form or other, have mentioned the fact that this is not a perfect bill. And we don't live in an isolated world. We're part of the Conference of Paris. We are signatory, and Dr. Okon also mentioned that as well. I think government is aware of that. I think over time this will be tweaked, and I think I've also seen a place in the PIA where it mentioned, I think talking about stabilization, saying that this will not in any way limit the government from introducing, for example, taxes which may be in compliance to promote environmental issues, which Nigeria is signatory to. So it's in anticipation that, okay, maybe with time, who knows, government may have its own version of carbon tax or carbon credit regime, just to encourage, movement to green in Nigeria. The third one, which I think is the most difficult one, is cost of transition. I think the cost of transition is going to be, will have to be measured from each company's level. But I think there may be some slight disruptions while everything is being put together. I think we need to look at the big goal of this, which is, one, for once we have certainty. Dr. Okon mentioned as part of his presentation that once you announce you want to make changes to your fiscal laws and to petroleum laws, investors suspend investments, and the waiting game starts to know what you want to put in place before they continue to invest again. Now we are over that. We expect that investors will start looking at Nigeria favorably again. Of course, notwithstanding the constraint we are now into, giving the campaign for transition from fossil fuel. So there will be some discomforts maybe at this early stages, while we are aligning, agencies are being realigned, and regulations are being released, interpretations are being sought. But overall, we need to look at the big picture. There is no other alternative than to actually set out with this PIA with a mind to succeed. Thank you.
Let me just add, let me add a comment that, at least from the government perspective, there is a cost to this, and one of the first cost is the cost of capitalizing NNPC. So that depending on NNPC's current balance sheet, there is a cost to that. The second is actually the cost of administrative costs associated with moving people and around, and the third. The third cost would be a cost just related to restructuring. So that may not be from a private company's point of view, but there is a cost to the government, and they are not insignificant.
Thank you very much, Dr. Okon, for that. Okay, Mr. Ezekov, take your question. I hope you got that, which I mentioned earlier. Let me just add this because I can see some questions coming in for host community. The other question is from Bayo Rojugbokon. He's saying, will the host community fund be established in each oil-bearing state or centrally coordinated as in the case of NDDC? Then the other question from Olawale is saying, what will the 20% in reserve used for eventually? This may just accumulate to a huge sum. So you can add that to your earlier question. Thank you very much.
Yeah, thank you very much, Nancy. So let me start with the last question about the 20% that should go to a reserve fund. So the idea around the 20% is to ensure that there is money to run the trust post a period when the operating company no longer exists, for example. So the Act try to make arrangement for a situation where there is continuous funding of the trust post when the operating company no longer exists. So remember, the trust is an incorporated entity, and it should live forever. So to that extent, the reserve fund is to keep some money aside to be able to run things going forward. Then the other question around the setup, the way the Act is written, the structure that is being run now is that each operating company will need to define what their host communities are, and they will run their structure. So if you have 5 operating companies within a set of communities, they will run their structures independently of each other. And of course, the commission is there to actually regulate over everything at the end of the day. Remember, I mentioned that the operating companies, the settlor in this case, will have to be filing their annual financial statement with the commission. And there are certain decisions that they will also need to take that will require the commission to clear and to approve, for example, the setting up of a board of trustees and the likes. So to that extent, the commission still play that oversight function over everything, but the structure that currently runs under the PIA is to have each trust fund being operated by the settlers. Then the other question around whether the existing MOUs will nullify whether the existing MOUs will be nullified by the provisions of the PIA. My response to that is that the whole idea is the PIA, the provisions of the PIA with regards to the host community development trust, is to once and for all solve issues around community development. So to that extent, it is actually meant to do some of the things that the current structure in terms of NDDC and the likes are currently doing. But where there is an MOU between an operating company and the host community, that is a separate arrangement. It is typically, if one should infer, that the host community development trust is the MOU, the existing MOUs are supposed to be subsumed and supposed to be absorbed by the host community development trust. But again, this is a law, and so it behoves on the operating companies to comply with the law. If there are existing MOUs, it then creates a ground for maybe coming back to the drawing table and discussing a couple of those things, but it does not automatically just nullify any existing arrangement or existing understanding between host communities and the operating companies. Also, don't forget that in the PIA, it is also mentioned that there is possibility for funds to come from other sources beyond the 3% that is specified in the Act. Thank you, Nancy.
Thank you very much, Mr. Ezeko. Now, the last question from a participant, and let me quickly take it from Mr. Ogujamilusi. This webinar we have to end by 11:30, so I'm really keenly looking at my time. After this question for the taxman, we would go into the second panel session. But Mr. Ogujamilusi, this question is from Amid Onikola. His question is, in regards with royalty payments mentioned earlier, the PIA allows the upstream to pay in Naira for domestic supplies. However, this is not considered in the case of gas midstream in quotes. supplied locally as the currency in US dollar. Considering the difficulty around our FX, is it not feasible and more business practical for the permissibility of the royalty payment to be in Naira, especially if this is the currency revenue that is earned? Mr. Gujem Lucy, I hope you got the question from Amit.
Yeah, thank you.
Okay.
Yeah, that is very clear. Thank you very
Okay.
much. The midstream is under Companies Income Tax Act. Under the Company Income Tax Act, taxes are to be paid in the currency of transactions. If you have earned your income in Naira under CITA, you file it in Naira. And if it is in dollars, you file in dollars. It's only the upstream sector where we say that taxes, that is hydrocarbon tax, and corporate income tax for upstream operation, it must be filed in So for midstream, income and in Naira, file in Naira. Thank you very much. And that's a very clear one. So it's only the upstream that must be in dollars. Thank you.
Thank you very much. Thank you very much to my panelists, panel one. Thank you. You've all done justice to your questions. Very insightful, session, I must say, quite informative and educative. So thank you to Mr. Olusegun Olujobi, Chief Executive Officer at Vertex Energy Limited, Mr. Gabriel Ogujem Lucy, Director, Oil and Gas, Federal Inland Revenue Service, Mr. Olumide Eson, Partner, Tax and Regulatory Services. Olumide is not going anywhere. He will still be there for the second session. So Olumide sits tight. Uyi Izeko is a Partner, Business Process Solutions at Deloitte. Thank you all for this session. Let's quickly move over to the second session. I'll start my introduction from the only lady I can see in the panel. So you all should just, excuse me for that. The only lady, Asiata Agboluaje, Partner, Tax and Regulatory Services, Deloitte. Israel Aye, Partner, Commercial and Energy Law Practice. And Olumide Eson, like I said earlier, is still going to join us. This second session is a Partner, Tax and Regulatory Services at Deloitte. So welcome to all of you to panel two. Are we all good to go? Let's start with the first question. And I'll also start with the lady there on the session. Let's start with you, Asiata. What should the companies be doing right now with respect to the unbundling of midstream and downstream activities from upstream?
Thank you very much, Nancy, and I appreciate the girl power. And yeah,
they've been men talking since, So
we're all very excited about the Petroleum Industry Act. It's long awaited. So on what companies to do, because now upstream and midstream and downstream operations require separate licenses that should be issued to separate companies. So a company that has activities spanning around all three should internally be looking at what it will do, identification of the assets, consideration, does it want to go ahead with any aspects of this business? And then they would start doing, and if they don't want to go ahead, they start considering maybe actual spin-off, acquisitions, and all of that. That is on one angle. There is the valuation of the assets to ascertain what exactly it is that I'm carrying for each line of business, and all of that. There should be models, so there should be considerations. Would I have more incentives to enjoy if I were to move to other to split and keep each of them internally? And then there's also the framework for the split. How do I achieve the split in an optimal manner? So these are some of the considerations that will be looked into. There are other legal and contractual considerations too, because if you've booked an asset or you've taken a loan on the basis that I have so many assets, I have these operations and have that. Some loans may even be in respect of some of the activities that have been spun off. So these are also has to be looked into, and then there are consent requirements that needs to be obtained from a contractual perspective.
Thank you very much, Asiata. I can see that the girl power is being encouraged in the chat box. Someone is saying that there should be a forum for women in oil and gas. Okay. So you can All right, let's move ahead to Israel. Israel, what's your opinion on the restricting of the regulatory agencies with reference to governance? What is also your take on the PIA's governance and institutional structure of the petroleum industry in Nigeria? Over to you, Israel.
Okay, thank you very much, Nancy. I have to say that I'm not entirely clear what the first leg of your question is, and you probably would help me understand it a bit more, but I can begin to, oh yeah.
Okay, let me ask the question again. What your opinion is on restricting of the regulatory agencies with reference to governance? What is your take on the PIA's governance and institutional structure of the petroleum industry?
Okay, well, so the big news here really is that for the first time in recent times, and by that I'm probably referring to the last 50 to over so years. If you think about the fact that the Petroleum Act was enacted in 1969, we have a statutorily established regulatory institutions, because the main issue with the Petroleum Act was the fact that it invested the powers, the authority, and the duties for policy creation, for regulation, and for quite frankly everything that has to do with the governance and management of the petroleum industry in one individual, known as the minister, whoever that is, male or female. Yeah, and everyone else who participated in the activity of policy formation or formulation and regulation was a mere delegate of the minister's power. Okay, and that's the big news right there. So for the first time in recent times, we now have an institutional framework. Okay, and whether wherever else you fall with respect to the dual regulation system and the single regulation system is a different thing. But the big news, right, quite frankly, is that there is a commission which is established by law. There's authority which is established by law. And I remember, I think it was Olumide who mentioned in one of his interventions that that even the appointment of the senior executives, the commissioners, and all the other sort of people are subject to ratification by the Senate. So in terms of security of tenure, hopefully, as far as it is practically possible, that exists. And in terms of its funding, you know, the regulatory agencies also have statutorily established routes of funding that would ensure their independence and hopefully effectiveness.
Okay. Thank you very much. Hello, thank you very much, Mr. Israel. Mr. Israel is Director, Aspen Energy Nigeria. That's his designation. Yes, thank you very much, Israel. Let's come back to Olumide. Olumide was on the first session, but you still have a lot to answer here. Let's get Olumide's take on the non-discriminatory third-party access to oil and gas infrastructure, that's pipelines, transport network, by the provisions of the Petroleum Industry Act, the PIA.
So thanks, Nancy. This is something that the regulators and NNPC have put for a long time. And of course, it is a well-established practice around the world. So having it in the PIA, it's a welcome development. And one of the reasons why it is important is to avoid cases of stranded resources. There is need for easy access by third party to main players, capacity. And this is not in any way designed to muzzle out, the owners of those assets or pipelines, as the case may be. But it's just to ensure that there is a regulatory framework, a structure around how a third party can utilize, available capacities to transport hydrocarbons, within Nigeria. So the framework is available, but there will still be regulations exactly how this will work. Remember, not too long ago, the government launched the National Network Code. So this is basically all geared towards ensuring that wherever we have resources within Nigeria, wherever we can produce in Nigeria, we can get those production either to market or to where they're needed. So that's the whole idea, around third-party access. And of course, everything around this PIA is designed to ensure that there is some level of unrestricted, market pricing. So it's not going to be a case of, going to provide your resources or your assets to someone else to use, at a loss, basically. So government is trying to encourage unrestricted market pricing, in section 205 of this PIA and also section 207. So I think we need to look at it from the point of view of a government that is in a race to monetize its resources, given the energy transition, and you want to get as much out of your 206 trillion cubic feet of gas, to the market or to be utilized locally. You want to get as much of your 37 to 40 billion barrels of oil equivalent reserves to the market as quickly as possible. So, removing all the constraints that you currently have, one of such is, is access. If you have located in a very, remote location and your resources are limited such that it will not be economic for you to run your own set of pipelines. What government is trying to do is that you could leverage on, on close by, facilities and assets by granting you third-party access, via these regulations. Thank you, Nancy.
Thank you very much, Olumide. Let me bring in.
Nancy, let me just.
Okay. Okay, Dr. Kohn, go ahead, please. Unmute yourself.
Okay, I think I'm on mute. All right. I just want to add two comments to that. I think the first is that if you go to the relevant sections, I think what we have is a delivered domestic obligation. And it just to buttress the point that Lumina is trying to make about third-party access. It is now obligatory that should you be asked to deliver gas, then you need to find the available pipeline capacity or contract that capacity to deliver gas, that obligation. So third-party rules are essential for enabling that to be done. The domestic used to be called a domestic supply obligation, but now it is a domestic delivery obligation. So it's not a play on words, it's to emphasize the importance of either contracting pipeline capacity or transportation capacity in order to deliver that obligation, which would be enforced. So I think it is it's important, an important indication of that. Then I just want to also mention that there is actually existing a regulation, the gas pricing and policy regulation of October 2008. And one of the, if you look at one of the paragraphs there, is the Department of Gas is supposed to ensure equitable and flat transportation of gas. And of course, those terms are very specific. And if you look at what NEC does, etc., but in the oil industry, gas industry, it was left in abeyance. So it was important for us to incorporate in the law these specifics to make sure that there is an obligation to either acquire capacity or to create that capacity to move gas domestically to clear the bottlenecks that currently exist. Thank you.
Thank you very much, Dr. Kohn. And I must also say that you can put your questions in the chat box for the second panel. Please do write your questions so that we can take them at the end of this panel. Okay, Asiata, I'll come back to you again, and I would like you to walk us through the legal, of course, as a seasoned lawyer, to walk us through the legal and regulatory issues that may arise with incorporation of NNPC Limited. We know, of course, it will be in accordance with CAMA, the CAMA law. So walk us through what may arise with incorporation of NNPC Limited with focus to shareholding and governance, voluntary conversion of unincorporated JVs to incorporated joint venture companies, and the transfer of assets and liabilities from the predecessor NNPC to NNPC Limited. So in other words, what I'm asking is that the old NNPC to the new NNPC Limited, what challenges and what may arise? Thank you, Asiata.
Thank you very much, Nancy. So as Dr. Okon mentioned, and I think other speakers have mentioned, the whole essence of having NNPC Limited is to make it a normal company that will be run as a profitable company, as any other company that we see on the stock exchanges or that we would put our money on should be run. So in this case, it's going to be set up, you mentioned, as a CAMA company, 50% owned by the Ministry of Petroleum and Ministry of Finance. And then there are indications that the company there may be some divestments in the future. So in this case, for that to be meaningful, the activities have to be run in a good manner with due corporate governance in line with CAMA and the relevant corporate governance rules. There should be more interest and more considerations around what happens, the profitability of the company, as the case may be. So with regards to conversion, so NNPC Limited, based on its own asset acquisition, it would acquire assets and liabilities as may be determined within, I think, within about 18 to 24 months from the effective date. And this determination will just be, okay, these assets are moving to NNPC Limited. Whether or not it will now be counterparties, which are license holders, whether or not they want to form IJVs with NNPC or its subsidiaries is another matter. And some of the conditions from a legal and corporate perspective to be looked into in determining this would, one, the conversion. So the conversion from the normal licensing regime to the new licensing regime as we have it now. So if that was the case, by the time you are converting or having an arrangement with NNPC holds, if NNPC holds the largest share in the company, NNPC would hold the shares too and have controlling powers. So you need to look at your economics, as Olumide mentioned earlier, before you agree and converge with your relevant parties to say, okay, we want to go ahead and do this conversion. Because if you are in a company, the shareholder has the party with the highest shareholder who just pass this resolution with just an ordinary resolution, which is just right above the other party. But again, there could be other schemes in place, like having a shareholders arrangement to say this step cannot be taken without having the other party in consideration. So there are other considerations, as Olu mentioned, the economics play a vital role. And in this, there are other contractual obligations. So companies have signed contracts. They've entered into financing agreements saying, this is what we are going to do, and this is what we're not going to do. From the company's perspective, and their asset base is dependent on certain activities. So if it's going to change, it would need to, one, probably contact their counterparties on the other side, on the financing side, and get some approval. So these are some of the considerations that need to be looked into from the company side. And then as we move and the assets move to NNPC, there needs to be a transitional framework for NNPC to actually set out the modalities and the criteria for choosing the assets that would go to the limited, or assets that would retain or maintain, or assets and liabilities that would be maintained with NNPC as we know it currently, or well, as we knew it before the PIA came on board. So because this would make a lot of would help companies plan and determine whether or not they are going or they're leaving. And because a lot of NNPC on one hand would want to keep out taxes, assets and liabilities. Companies, on the other hand, is looking for the limited liability company that would be viable and they have control over. They can say, okay, there's more basis for them to get something out of their business. So that correlation and that framework needs to be in play and come out appropriately. So that is on the one hand. And then having at the end of the 24 months, if there is no framework, we know that ultimately it evolves round to NNPC Limited, but there is a framework for companies that can now be handled with federal government with no framework of how their assets and liabilities will be settled. And one thing that we should avoid, because there's a leeway or a loophole that companies can actually do and say they just start an action or commence a lawsuit against the NNPC just before the deadline, so that the assets and liabilities or the lawsuits will carry over to NNPC Limited. But these are some of the things that needs to be in play. The transition framework is very critical, and one, it will keep people, it enforces, engenders trust in the system, and it engenders transparency. Thank you.
Thank you very much, Asatia. Let's move over to Israel. Israel, please take a look at the PIA's gas commercial principles and incentives, if they are sufficient enough to attract the right investment across the gas value chain. Because of course, for Nigeria, perhaps we are more of a gas country than even a crude country.
Yes, that's effectively what everybody says. But there's a lot to unpack in that space. But let me also just add a comment to one of the questions that was raised in respect of gas previously, or perhaps in respect of the whole transportation network. I would imagine as well that a couple or so of the thinking behind the thinking behind the gas network code is the fact that one of the major constraints in terms of gas commercialization in Nigeria has in fact been the lack of an infrastructural network. Okay, and in order for that to happen, you basically need a network. You need to be able to flow gas up and down the country from north to south. You need to be able to float it definitely 2 ways, from west to east and east to west, you know, and then to be able to supply somewhere within that grid system. Companies that rely on gas either for power or indeed that rely on gas as feedstock for the process, which we generally refer to as gas-based industries. So that's definitely one of the reasons. The second one, which is implicit within what I've just said, is efficiency. I mean, if you have standalone pipeline systems, that's not a network, right? And so you tend to have overcapacities, because it's unlikely that when anybody's going to build a pipeline system, they build it exactly to the capacity that they intend to use. They probably build in a bit of fat, and that fat may stay there for a while. You have to remember that one way or another, either in terms of JV funding or in terms of cost deductibility for tax purposes, government and the Nigerian people ultimately are bearing the cost, or the cost of such inefficiencies within the system. So apart from the need to have a gas network or an infrastructural network that delivers gas to every part of the country in order to be able to drive industrialization, you need some cost and operational efficiency within the system in order to be able to get us to where we need to be. So what has happened with gas commercialization, the question you asked me, we essentially have embedded all the standalone regulations. So the so-called DOM gas framework, which I had the privilege of participating in framing. At the time it was, along with certain individuals, and was a regulation, or is the 2008 October regulation, has now been brought into the law. In addition to that, the network code has been brought into the law, and a number of these commercial frameworks, the gas flare framework has been brought, also underpinned by a regulation, has been brought into the law. So you have a situation where the gas commercialization framework sits within the law, which is the highest form outside of the constitution of the law that it can sit in. And that in itself is a good development, and usually investors would like that amount of certainty in order to be able to put their money. You have to also remember that the infrastructure fund, was also established by this act, and hopefully there is some funding within the next 24 to 36 months, beginning at that sort of time, to be able to invest in critical infrastructure. Because remember what I said at the onset, that one of the major bottlenecks for gas development in Nigeria on a large scale is just basically a non-existent, robust infrastructure network that spans the entire country. Hopefully, there is some seed funding to put our money where our mouth is, and to be able to make that sort of backbone investment, which will hopefully attract private investors to come into that space. Ultimately, it is the extent to which we can incentivize private investment that we're going to be able to grow. Nothing would be dependent on government investment alone. And I think that the beginnings of such a framework exists. What do I consider a missed opportunity? I think the failing to liberalize gas pricing, and it's a good thing and there's probably a dual system, the managed system and the not managed system. But you would imagine that at the onset, particularly for most of the local players, they're going to be playing within the managed system. I would have hoped to, it would probably have been nice to see a sunset to the price control, because there's a difference between price control and price regulation, at least the price control framework. But we'll watch how that unfolds.
Okay, Israel, just still hang on there, because I don't know if I got a bit of reservation when I said earlier that, there's this notion that Nigeria is a gas country than more of a crude oil country. I saw a bit of your reservation. You do not agree? 260 trillion TCF is against that 7 billion barrels of reserves which we have. So I want you, to shed light on that. Was that a reservation?
No, Nancy. The data is what it is. It speaks for itself. Especially if you think about the fact that a large part of that data point probably came from exploring for oil, and it is what we have found while looking for oil that we're probably banking. I would imagine that if we have very deliberate gas exploration, the numbers are going to be higher. But you see, for far too long, we have focused on the size of our potential, and which is, so if I chuckled or guffawed, it's not because I'm contesting your data point, but I'm saying that beyond that potential, what practical steps do we need to take to actualize that potential? And one of them is what I already talked about, the infrastructural, the transportation infrastructure needs to be in place. We need to have a clear strategy, not only to deploy seed funding, but to incentivize private participation. Yeah, some of the biggest gas transportation companies are not in Nigeria. That in itself is an indictment. People who have thousands and thousands of kilometers of gas infrastructure elsewhere, considering the potential of Nigeria, are not even biting at all. That's why we're leaning on independent or third-party access rights, as a matter of fact, as the backbone of our infrastructure network. That is not good enough. We need to be able to deploy policies on the back of the existing law. And perhaps one of the big things around there is even just the liberalization of prices. Because if the operators of such gas infrastructure, gas infrastructure were to come in here, they would want to know that they can recover on their investment from a cost-reflective market. So that's probably where we need to put a little bit of extra thinking.
No. I think I've heard this so much about prices and pricing. Well, your former employers, Shell, would I'm not sure they would agree to that. You have an LNG contract that actually has subsidized gas. The body that set this thing up, and we debate the
That's a line is written.
Subsidized price under the concept of well, I hope not.
Okay,
Excellent.
Can you hear me?
now.
The issue is not whether there is a liberal. The system is open, and those who wish to develop gas and deliver to the domestic market have the right incentives. The regulator is not in the business of stopping people from investing. You are supposed to come up with your tariff methodology, and if it makes sense, you go ahead and do it. But to suggest that we have a discriminatory pricing system in which gas prices for export are lower, about a third of what we are selling for the power sector, is complete. No nation does that. So we cannot have a pricing scheme that disfavors the Nigerian people. So if anyone wants to, the pricing scheme should be based be on the same basis. The regulator is not going to set a price, but is going to look at the basis for which transportation tariff is the methodology. And secondly, we hope that when the regulator, the authority comes into full force, there will be, for the first 3 months, a review of all these pricing methodologies. Okay, so I think that there wouldn't be discriminatory pricing. And this so-called liberalized pricing where you don't have infrastructure, there's something called the theory of natural monopolies. And FCCPA will deal with that problem, and it's going to come. Because we don't want to create a natural monopoly headed by the 5 big boys, and they are dictating prices to the domestic market. That's the reason why you don't have a so-called liberalized scheme when the market is fixed.
Nancy, can I say just one quick word in response?
Okay, you can go ahead.
All right. So, Doctor, you know we've been over this whenever we have the opportunity a few times, and I agree with you that it has to be managed in the first instance. But what I was referring to is, perhaps, I mean, because the pricing framework is hardwired into law. What I was thinking about, and if you recall, the pricing framework under the gas master plan was supposed to sunset at some point. And so what I was referring to is a provision that says that when we attain a particular threshold, it then becomes that sort of open regime. But that said, let me also mention that the taste of the pudding is in the eating. And to the extent that we have not been able to attract the biggest investors in the infrastructure, gas infrastructure space, gives us something to think about. And I'll rest it at that point.
Thank you very much, Israel. Thank you, Dr. Kohn.
We'll take it off line. I'll call you and we'll talk off.
Okay. Let's bring in Olumide with I think we're almost, because we have less than 20 minutes to wrap up, this webinar. Olumide, I want to merge these 2 questions in one, and I hope you get them. What is the impact of domestic crude oil supply obligations on local refiners, on marketers, distributors, retailers of petroleum products? The second leg of the question is, what is your assessment of the PIA's framework to guarantee steady supply of petroleum products? So they're almost like, the questions are intertwined. Olumide.
Yes, thanks, Nancy. I think it's been very interactive and interesting discussions. I think sometimes last week, I think Dr. Kohn and I had something similar to the friendly chat between him and Israel just now. All right, so back to the question on the DSO, the domestic supply obligations. It's a provision of Section 109 of EIA. And what it does is to empower the commission, okay? That if there is a national need for crude oil, for refining purposes, it can be enforced in a way that companies first satisfy their allocation of that DSO before they can, make export. So what it does is to guarantee local supplies. And again, this is not unique to Nigeria. In fact, in not too distant past, I was involved in another country where the conversation was also on about domestic supply obligation. I think what is important is to ensure, like Israel mentioned, that it's unrestricted market pricing. Okay, I mean, so if you're going to force me to sell domestically as against export, I must be able to realize a comparative price, even though I may have, contractual issues to deal with outside, but at least I must ensure that what I'm going to sell locally compares with what I would earn if I were to have exported the same crude oil. So that's the bit about the DSO. Now, talking about security of supplies, NNPC has been made supplier of last resort in this act. And so the whole essence of that is to ensure that if all fails, NNPC will ensure adequate supply of petroleum products in Nigeria. That's guaranteed and coded into this law. So that security is there, and that NNPC will be the supplier of last resort. Thank you, Nancy.
Thank you very much, Olumide. You can continue to send in your questions. I've seen those questions. So I would say at this point, we've come to the end of, asking the panelists the questions. So we'll take the questions from the participants. Let's take a few questions. Okay, Olusegun is asked, sorry, let me take this. Okay, Ibrahim is saying, what an insightful discourse. Thank you to the panelists and moderators. Thank you for joining us. I would like to know if both sessions will be shared and publicly accessible to participants. It will be shared. The recorded video will also be downloaded on YouTube. Okay, this question is from Joshua. For companies unincorporated JVs with subsidiaries of NNPC such as NPDC and APIMS, in a situation where these subsidiaries are given a mandate to convert to the PIA fiscal regime as provided for in Section 93 of the PIA, and their counterparties insist on not converting, how will the provisions of parceling of acreage and relinquishment of this field area play out on the event of such an impasse? This is such an interesting question from Joshua Izwaba. We'll take that now. I guess, Mr. Lumide, you can take that. Then if Mr. Yes.
Can I pass this on to Mr. Okon to take, please?
Okay. Dr. Okon.
That's Dr. Okon.
Dr. Okon, you can take it.
That's okay. My team Okon is even better. I think, it's a commercial construct, and the parties will negotiate on the basis of their perception of where value lies. And I think that it is not the duty of the law to impose on any of the parties. That's why it's voluntary conversion to an IJV or voluntary conversion to a fiscal system. And if the parties cannot agree, to some extent, the commission, can use its powers to mediate that particular process. But again, there is no imposition, and the commission is not a mediator, and the process by which that can happen.
Oh, Dr. Kohn, okay. Dr. Kohn, the network from
the subject for regulations as when they.
Okay, Dr. Kohn's network is freezing.
Network is unstable.
Yes. Dr. Kohn, your network is unstable.
Nancy, can I add to now that Dr. Okon has spoken? So, my view is that, as he has mentioned, under the second schedule, the incorporated JV, it's voluntary and it has to be negotiated. Let's be reminded that for contracts involving the joint ventures, for example, licensing and rest of them, you would normally see the signature of all the parties involved, so the application could not be made by one party on behalf of others. I think where we need to see more transparency about how this could work is in the space of the production sharing contract, where NNPC is the lessor. So it's good to know, or the lessee rather, how exactly to pan out in the space of deep water. If NNPC wants to convert and the contractors are not favorably disposed to converting, whether or not the regulator will mediate, that remains to be seen. But I think on the JV side, I think that is less likely that one party will impose on the other. But from the deep water, if we note that the owner of the license is NNPC, and as a matter of fact, this act also vests it on NNPC on behalf of the government. So the question is, what would happen if NNPC would like to convert a production sharing contract and the contractors are unwilling to convert? And that remains to be answered, really.
If I may add, hello.
Okay.
Yeah, so I was going to add to Olumide's comments too. So for the unincorporated JVs, the terms, considering that all the terms of the agreements that they have signed are still binding, so the terms of their JOA and all of that will come to play here. And as Olumide mentioned, one party cannot, on this kind of major issue, one party cannot on behalf of another go ahead and sign this kind of contract. Then on the PSAs, again, the contracts are still subsistent, a lot of them with stabilization clauses. So these are some of the things that would have to be weighed, even by the NNPC, having as the OML holder in PSA situation. So, but it remains to be seen how all of this will play out, and a lot more how it will play out as we implement the PIA.
Okay, thank you very much. Let's bring in Israel.
Let me just add a comment.
Yes, go ahead very quickly.
Okay. I don't know whether my sister. Yes, I was just going to say that the only reason why you have a conversion is simply because there were ongoing discussions between the NNPC and for the PSCs and the contractors, and I think that they were close to closure in at least one of those agreements. So I think that is what informed the whole conversion process to this new term. So I wouldn't like to say, I wouldn't like to say that there will be much disagreement around those. But for the JV, obviously, the shareholders' agreement will have to be agreed, and the parties cannot act. They will deal with that matter when that comes.
Thank you very much, Dr. Cohn. Israel, a question for you. The Nigerian petroleum industry has been bedeviled with various policy uncertainties, poor infrastructure and insecurity in time past. Are there provisions that address these concerns in the PIA? And what should operators in the oil and gas sector expect with the signing of with the law, the PIA law? I guess you must have answered this a bit during your session, but just, come through with some answers for this participants.
This question, okay. Just to lend a vote, my voice to the previous question, and then very briefly, I'll get to it very quickly, is that, the question of whether there is internal alignment between joint venture partners is a joint venture relationship or management issue. The anticipation of the law is that when the venture, if the venture makes a decision to convert another convert, the venture comes. But it does not, the law does not prescribe anything and should not in fact prescribe anything about how joint ventures, venture partners manage their relationship, including, and I'd like to say even PSCs, because PSCs have their internal governance framework as well. in a document they typically refer to as their own JOA. And indeed, even the PSC document itself, I've worked with those over the years many times, and I don't see why that's going to be an issue at all. Generally, with respect to the question that you have then sent to me, hopefully one of the things that has happened here is that we have a better governed industry than we had. And next to certainty as an incentive for investment is really governance. Priority is given to governance. Investors, both local and international, are unlikely to come to any environment that is uncertain and that is chaotic. And what has happened is that there is a very clear institutional framework. On the one hand, improves governance. Another thing that has happened is that for the first time, we have elevated the issue of benefits transfer to statutory level. It may not have attained the level of resource control, and we cannot sleep over that generally. But as far as benefits transfer is concerned, that is no longer left to the will and the discretion of the communities and the companies. There is a framework, and I think directionally or conceptually a good one. And the only regret is that things went really bad, and the social and civil structure is really quite collapsed. And how quickly will it regenerate the system, build trust again in order for us to be able to operationalize it, is left to be seen. Beyond the provisions of the law, I would imagine that at the point of implementation, not only by the steering committee, but by everybody concerned, there is a lot more work to do in order to realize and to actualize the benefits or the inherent benefits of this law. If I was to echo something Mr. Olujobi said earlier, and I agree with him completely, is that this is an excellent law if it was passed 20 years ago. But it is what we have now. We're grateful for it. We hope that it works. Or we can.
Thank you very much. Thank you very much, Israel. We just have a few minutes to go. Asiata, let me ask this question from a participant, and in just less than a minute, if you can answer. The participant asked, you mentioned that the assets not transferred to NNPC Limited would be retained with NNPC as we know it. That is confusing to me, considering NNPC as we know it no longer exists. Very quickly.
So based on the law, NNPC as you know, it still exists, and it will still exist up until time. So there's a framework that to move assets and liabilities from NNPC to NNPC Limited. The ones that government has decided not to move will still be with the NNPC. And then the Minister of Finance will set up a framework to determine how these liabilities will be resolved. If there is no determination on whether assets will be moved or otherwise within 18 months, then all assets and liabilities of NNPC as we know it would move over to NNPC Limited. So NNPC as we know it is not dead yet. It will be dead when all the assets and liabilities that are in it are completely extinguished.
Thank you very much, Asata. And I think at this point, it's as if the webinar shouldn't end because it's quite interesting, very insightful. But I must say this is the end of the panel session and perhaps the webinar. So thank you very much to my panelists, my very, great panelists, panel 1 and panel 2. I've been speaking with Olumide Eson, Partner Tax and Regulatory Services, Deloitte, Israel Aye, Director, Aspen Energy Nigeria, and Asiata Agboluaje, Partner Tax and Regulatory Services, Deloitte. It's been a pleasure hosting and moderating this webinar. It's been insightful, it's been rich, it's been great for me. Great expose, I must say, to the Petroleum Industry Act. Thank you also to Deloitte. But I will bring in Yomi Olugbenro, the West Africa tax leader, to close this webinar. Thank you to Deloitte for bringing me on board. We hope to see you again next time. I am Nancy Naji. Have a wonderful afternoon, everyone. Yomi, over to you.
Thank you so much. Thank you so much, Nancy. And I agree totally with you. I think this has been a very insightful session. I love the participation and the engagement, and maybe my thank you should start from you, Nancy. I think you moderated it so expertly, so you can catch your breath now and get on air for Moneyline. All right. So
my show's already on. You've taken 30 minutes.
Only Deloitte can do that. So for a conversation as critical as this, so thank you so much. You've done so well moderating the session, and I want to very specially thank all our speakers and panel member. Dr. Tim Okon, we are sincerely grateful for your insights, not only for the keynote, but also for the very strong and valuable interventions that you make every now and then. This is how we want our sessions to be, and you've delivered quite capably. Ms. Ogunjemi Lucy, well, we are forgetter, so we sincerely appreciate you on this. Thank you for being here. Thank you for your insight. Mr. Olujobi, I mean, we can't thank all of you enough. The promise to all of the participants is that we're bringing in a team of experts that will deal expertly with all of the issues, and you've done so creditably. Israel Aye, thank you so much. We really appreciate your involvement in the bill and all of your effort in the process leading to the passage of the bill. It comes quite clear, and I really appreciate everyone. So maybe to my colleagues on the call, well, thank you for your sessions. I really appreciate, and to our participants, most importantly, thank you for staying through. At some point, I saw the registered attendees rose very sharply above 500. We deliberately wanted to limit it at 500. We were moderating the number of people who could join because we wanted it to be very closely knitted, in as much as we know that a vast majority of people will want to be part of this. So we really appreciate the fact that you are on. Thank you for your engagement. And we just want to assure you that, this is what we do every now and then, making sure that we bring insights that can help you in your business place. We have a long list, a long lineup of experts that can help you with, different areas of, navigating this, this Petroleum Industry Act. You've had 3 of our colleagues, engage with you. Oyi Izeko is a technical accounting expert, so everything relating to to accounting, to business process solution, and all of the needs as far as this area is concerned. Oyi is your go-to person. Ashiata Goluaje is a lawyer and regulatory specialist and expert, so in the field. So the house is filled with a one-stop solution. And of course, Olumide Eson is energy and resource expert, is the industry leader. And I guess that's why Nancy makes sure that she kept her on for the 2 panels, so you can't get all of us here and not, and not spend so much time. So we just really want to appreciate you. As has been promised, you will get copies of the presentation with approval of Dr. Okon once that is done, and the recording as well will be, will be accessible. If there are questions that we've not been able to deal with online, the technical team behind the scene we collect them and make sure that we reach out to you. My final thanks is to my CEO, who, in spite of very busy schedule, is also, stayed tuned from the beginning to the end. I think that's his own way of making sure that he meets his mandatory professional education continuous hour. So online, Fatai, I can let you know that your license is now renewed. So thank you for thank you for staying through, and thank you everybody for being part of the call. Fatai, you want to say thank you for renewing your license?
I think it's just an appreciation again to thank everybody for staying through this program. We appreciate you, and we hope to see you soon. Thank you very much.
All right. Thank you, everyone. Thank you. Thank you, everyone. We sincerely appreciate it. Enjoy the rest of the day. It's 11:30, right on the dot as promised.
Bye-bye.
Thank you.
Bye, everybody.
Thank you.